So at the end of the day, the market does not like uncertainty. And what we are saying is a lot of uncertainty from Washington and from the geopolitical scene. So first, tariffs, that's been the main driver of a lot of this. It's something that we haven't seen before. Lots of folks reference tariffs leading to the Great Depression and kind of an elongated protraction. So tariffs is the biggest name of the game. That's what's driving a lot of this volatility. Putting tariffs on some of our biggest trading partners and kind of what that will do to inflation. So the first element is tariffs. The second element is what tariffs will do to inflation and kind of our GDP. So at the end of the day, GDP is what governs recession. Are we in a recession? Are we growing or not growing? So the fact that these tariffs can potentially lead to slower GDP when some folks were already concerned with our growth rate is what's driving the market lower. Secondly, within that vein is that tariffs can make goods more expensive. So some folks have talked about the cost of a car. So a car goes between the US and Canada, back to the US, back to Canada, down to Mexico, and back to the US market. So that might add $3,000 to $6,000 to the cost of a car. And folks are concerned that when inflation has already been sticky, we haven't yet met our 2% inflation threshold, that these tariffs might be an additional burden to getting lower. So the perspective is rates might stay higher for longer because the tariffs are being a little bit sticky to inflation. I don't think that's the case. I think that you can't have a slowing market. You can't have less demand as a result of tariffs and have rates stay high. I think that people are just overthinking a lot of these areas. One issue might be stagflation, where inflation is a little bit stubbornly high and growth peters out a bit. That might be the biggest burden on folks' mind. The last area is what's driving the volatility in the markets is that the geopolitical risk in Ukraine was seen as expanding. So just kind of without being overly political, folks, I think, thought there was more uncertainty as a result of what happened in the Oval Office a couple weeks ago and kind of anything that had to do with peace talks. The reality is, for the most part, geopolitical risks are fairly contained. The markets usually react shallow and quickly to geopolitical risks. So I think a lot of this has to do with just normal market gyrations. So one of the things that we always tell clients to do is to zoom out. So when you look at a 1-year chart, it can be kind of scary when you see the market decline 20 or 25% in a given year. But the reality is, as you zoom out, as you get further and further away from 1 year, be it 5 years or 10 years, they tend to look like blips on the radar. So for the most part, they can be buying opportunities or things that you should ignore, so long as you're not overextended and over your skis in your risk factor. So when you look at it, any calendar year has about a 75% probability of being positive. As you zoom out, you go to 3 years, that probability goes up to about 90%. And as you get to 10 years, it's 98%. So using a longer lens, we shouldn't be as reactive to these things. What I tell a lot of clients is declines from 0 to 10% happen all the time. I think there's been about 30 instances over the last 20 years of a 5% market decline. So that means once or twice a year, this sort of thing happens. Typically, it takes about 30 days to recover. So we shouldn't be overly worried that it's going to be a long protraction. And usually the decline is about 7.9%. So not overly impactful. So the odds are skewed in our favor. We either have to look at this as a buying opportunity or as a stay put. And things could get worse, but I just don't think that the evidence and the data are governing that just yet. So my rule of thumb is that you should always be contributing to your investment accounts so long as it's economically viable for you to do so. If you are able to maybe turn over the couch cushions here or there and find some extra dollars to deploy, I think that can be really helpful, so long as you're not going to be overextending yourself by buying, because it could be a year or two before things really get back to normal. So long as they're longer term funds, I think that buying during declines is a very positive thing. If you can step up the amount you're contributing either bi-monthly or monthly or quarterly, I think it's a great time to do so. And remember that volatility is part of the markets. Most folks tend to think that markets only go higher and it should be very linear, but that's not really the case. What's interesting with this year versus 2024 is that the most volatile period during 2024 was not as bad as the volatility we've already seen this year. Even though this year is not even as bad as most years historically so far. This is a very average correction during a calendar year, so that helps put things in perspective. So I think that being a little bit more defensive when there's heightened volatility is going to make sense. So most of the areas that might do a little bit better will be healthcare, for example. Folks need to be healthy regardless of whether we're in a recession or not. I would stray away a little bit from more the sectors that are a little bit more speculative. And that has less to do with sectors and more just kind of the types of companies that you're buying. Are you buying companies that have stable cash flow? Are you buying companies with a track record of success through good times and bad? Or are you buying the more speculative vintage? So for example, Rocket Labs is a rocket ship company that we like and has done good things. But during the bear markets, during the recessions, those types of stocks tend to get beat up pretty badly. The Johnson and Johnsons of the world tend to be a bit more defensive. So have a diversified portfolio is absolutely paramount. You really shouldn't have one or two stocks that will make or break your portfolio because that's really bad risk management. At the end of the day, if you're diversified, as if you're staying invested, if you are continuing to make contributions to your account, all these things should be blips on the radar. It's avoiding the big miss that will be really important. Don't be overexposed to one stock. Don't panic and sell everything into a bear market. So long as you avoid the biggest pitfalls, you'll be able to get through all this okay. So depending on where you are in your timeline, you have to invest differently. Somebody who is in their early 20s who has lots of positive cash flow can afford to be extremely aggressive during periods of volatility and not. So for example, somebody who's in their 20s and they have $25,000 lying around, they can just say, full steam ahead. The market's down 10%. This is a great buying opportunity. And over time, they will be proven right because the market is undefeated at getting back to all-time highs. That said, as you get closer to retirement, think of somebody in their last few years of working, you have to be more cautious. So if you are 1 year from retiring and the market is down 50% and stays down for a long period of time, you are in a much worse situation. So you have to err on the side of being a bit more conservative as you get close to retirement. As you get into retirement, things become even more important. You're not able to withstand a 1 or 2 year bear market without pulling from your accounts. So it's really important to not be over your skis. Somebody that is retired and pulling dollars each month or each quarter from their investment account will not have the inevitable run up in their account. They will have pulled those dollars out and spent them on other things. That 20-year-old, it's just paper gains and paper losses. For folks that are pulling from their account, they have to be a lot more cautious. And that's why we run Monte Carlo simulations that takes into consideration the worst possible market environments for those folks that are in the early stages of retirement or are about to retire. Those things become vitally important. It's called sequence of return risk, that if you retire into a bear market, you are exponentially worse than somebody who retires into a bull market. The order of outcome really matters.